Hello, my name is Phil Blancato, and I am Chief Executive Officer of LTAM Asset Management. And welcome to our third quarterly wrap-up of the latest current economic conditions. Well, I'm sure many of you are keeping a close eye on what's going on in the stock market and the bond market. There is no doubt that volatility has returned to the markets, and we are without a doubt in a quote-unquote transitionary phase between low volatility to much higher volatility. And there's a number of reasons for it, but when we look back at how the second quarter and the third quarter performed, the second quarter returned over a 4.6% GDP in the United States, and the third quarter is probably going to be north of 3% at current estimates. So far this year, the economy for the United States has actually been pretty darn good. When you think about unemployment, it has steadily improved all year long, and in fact, we've added nearly 200,000 jobs just about every single month of the year. Unemployment has fallen to a low of 5.9%. I know inside those numbers there's lots of underemployed and some no longer work looking for jobs type folks, but by and large the numbers are certainly better. So the U.S. economy continues to strengthen. You, the consumer out there, is continuing to be in better shape. You're saving more money, you've cleaned up your debt, and in fact you're actually not making more money per year, but you're not spending a heck of a lot more either. So the U.S. consumer is in good shape, and our economy is by and large healthy. As the economy strengthens, there's been some concerns about interest rates, that interest rates may start to go higher. And when interest rates rise, usually that brings lots of volatility into the marketplace, and that's why in early September we saw some of that. By and large, we believe the economy in the United States is still very, very healthy. In fact, we think it's going to get better. We're on the cusp of an American energy renaissance, with our own cheap energy coupled with lots of labor that we can use to repower our own manufacturing. The United States is actually looking better and better quarter over quarter. Still plenty of room to grow. Still lots of opportunities to get that bigger. We're used to growing at 4%, where today we're growing at just around 2.5 to 3. But all the signs are positive for the United States. And in fact, post the second term election, meaning post a presidential election, in the president's second term and in their third year, which will be next year, the markets generally are very, very positive. In fact, post most November elections second term, the market continues to pick up. So history is on our side, and the U.S. economy certainly looks stronger. However, part of the other reason for volatility is the international economy, or the European economy, continues to be very problematic. You see, Europe is shrinking. They are having real trouble growing their economy, and they're trying to create lots of stimulus. In other words, not unlike our quantitative easing, they're going through a very similar approach. They've actually made a decision that they're going to stimulate their economy by printing money to some great degree through loans. And so far it hasn't actually worked. They have no inflation. In fact, they might be deflating, which is very dangerous to a global economy. And their manufacturing base is not growing really at all. When you look at Germany, and Germany's slowing down, Europe is struggling. And as Europe struggles, that brings waves of volatility into the U.S. market. We have limited expectations for the European economy over the next 12 to 18 months. Emerging markets. Emerging markets in the European economy and the U.S. economy are mostly tied together from the standpoint of commodities. As China has slowed down to some degree, and Europe has slowed down, and the United States not growing really aggressively, commodities are beginning to take it on the chin a bit. And that means that the emerging markets follow suit because they produce so much in the way of commodities. Couple that with the strengthening U.S. dollar, because the U.S. economy is getting stronger, emerging market economies are also struggling quite a bit. And then finally, when you think about the other aspect of your portfolio in the fixed income standpoint, fixed income has been a bit of an unusual marketplace. At the beginning of the year, there were lots of scares about the fixed income interest rates going higher, about the Federal Reserve potentially raising the federal funds rate for the first time in years. Well, between the beginning of the year to now, something very unexpected happened. Interest rates have actually gone down. You see, the U.S. bond market, the 10-year, was yielding just around 2.5% for most of the year. And when the rest of the world realized they could buy U.S. bonds at 2.5% versus buying a German bond at 1% or a Spanish bond at 2.5%, the world woke up and said, I'd rather own a safe U.S. 10-year Treasury at 2.5% than a bond from another country at a much lower rate or the same rate but with more risk. And for that reason, external factors have really driven down the interest rates on the U.S. bond market, somewhat unsuspected. However, over the next 6, 12, 18 months, as the U.S. economy strengthens and the globe levels off, we do think interest rates will slowly rise. Just not this so far. And in fact, our bond portion of the portfolios continues to be very strong because we've allocated just in case this happened. So in conclusion, the U.S. market continues to be very strong. There is volatility, partially because of the election season, partially because of some concerns around interest rates, partially because some of the U.S. housing data is a little bit mixed. Housing is not as strong as some folks would like. Wages are not growing as much. So we're seeing some volatility from that. Europe is somewhat problematic. There's some unknowns we need to get through. And hopefully the stimulus in Europe will start to kick in along with emerging markets as well. And of course, fixed income remains a stable part of the portfolio as interest rates are stable now or even going down. So we believe that there will be continued volatility through at least the election season, but post the election season, there should be some normalization and, in fact, a return to an uptrend in the equity market. We still think the equities will be positive for the year, and we think fixed income should remain somewhat stable the rest of the way. We hope this was helpful for you. It's a quick tidbit of how we see the economy right now. You're welcome to read our extended market commentary that we provide, and you're also welcome to dial into any of our quarterly conference calls, which will cover the economy in much greater detail. Again, thank you very much. Hope you have a wonderful holiday season and look forward to maybe meeting you all someday in our travels along the country. Thank you. Bye-bye.